Howdy, everybody. Welcome to Liberty Call. Today is Friday, March 7th, 2025. Hope you're having a fantastical day out there on the interwebs. It's a gross day here in Colorado. It's overcast. It's, it looks like it's snowing finally. Got a little snow, got a little drizzle. It's just gross and cold outside. So hope wherever you are in the world, it is nicer than it is here. All right. Well, markets are sinking again with the Dow down. Well, it was down. Actually it finished up, I believe. Yep, it did finish up. See. Well, indexes were down earlier as investors react to weaker jobs numbers and Powell's wait-and-see stance on rate cuts. In corporate news, Broadcom is soaring 10% on strong AI chip sales, while Walgreens is jumping after announcing a $10 billion bailout, and HP Enterprise is tanking 20% after disappointing earnings and layoffs. Meanwhile, Trump just signed an executive order establishing a $17 billion Bitcoin reserve and branding it as the digital Fort Knox. Wow. I'm excited about that. All right. Well, before we break it all down, if you could do me a favor, if you give me some thumbs up, a like, share, subscribe, or follow, and press the notification bell. Let's get into the markets. All right. Let's see here. Dow Jones was up 0.52%, closed at up 222 points, closed at 42,801. S&P 500 up 0.55%, 31 points, closed at 5770. NASDAQ up 0.7, 126 points. Closed at 18,196. The VIX was down today, 6.03%. It's at 2337. Canada up 0.71. Brazil up 1.36. And Mexico down 0.13. All right. Headed over to Europe. Germany down 1.79%. The UK down 0.03. France down 0.94. The Netherlands up 0.07. Spain up 0.17. Italy down 0.48. Switzerland up 0.49. And Portugal up 1.95%. Russian exchanges red again today. MOEX down 1.35, RTSI down 0.87. And the overnight markets, mostly red, or all red. The Nikkei in Japan was down 2.26%. Australia down 1.81. New Zealand down 1.44. In China, the Shanghai was down 0.25%. Shenzhen Component down 0.5%. China A50 down 0.03. DJ Shanghai down 0.24. Hang Seng down 0.57. And the Taiwan weighted down 0.61%. All right. Well, let's go to the. All right. Used to clicking certain buttons and they changed it on me. So, all right. Let's bring up the weekly chart of the Dow. Come on. 1 week. There we are. So let's see how. Well, I can tell you right now just by looking at it, it's going to be red. Dow Jones is going to be finishing the red by 2.37% this week. The S&P 500 down 3.09. The NASDAQ down 3.42. Dow Transports down 2.35. And the Dow Utilities down 1.39. So everything across the board looks yucky. All right, well, let's go to, let's zoom out to the daily chart and see what that looks like. As we can see, this is the election right here, early November, had a nice spike. Then it came down, then it jumped back up at the beginning of December. Then we had about 6 weeks of a downturn going into mid-January, spiked again. So that's kind of these, humps, be the best way to call it. So what I'm looking for here is, are we going to break this right here, where it bottomed out last time in early January? Are we going to break about 42,000? And if we do, I would think that the downtrend would probably continue. If it bounces, we could be doing this for quite some time, just kind of bump, bump, bump. Let's go to the S&P 500. Chart looks a little different. But again, the same downslide that we've had going back. How many days is that? 16 days, so about 3 weeks. So we'll see. And the NASDAQ chart looks very similar to the S&P. All right, well, let's get that off the screen and move over to everything else that's important out there. All right, well, let's bring up the economic data that came out this week. Why did it do that? Come on, back up. All right, starting out with initial jobless claims, came in at 221,000. Forecast was 234. Previous number was 242. Continuing claims came in at 1.897 million. Forecast was 1.88. So a smidge above forecast. Previous number was 1.855. The ISM Manufacturing Purchasing Managers Index came in at a 50.3. Forecast was 50.6. Previous number was a 50.9. Total vehicle sales came in at 16 million. Previous number was 15.6. ADP non-farm employment change only grew by 77,000. The forecast was 141. Previous number was 86. So a bit of a drop there. U.S. factory orders month over month grew at 1.7%, right on forecast. Previous number was a 0.6 contraction. The ISM non-manufacturing purchasing managers index came in at 53.5, just above forecast of 52.5. Previous number was 52.08. Non-farm productivity quarter over quarter grew at 1.5%. Forecast was 1.2. Previous number 2.9. The trade imbalance came in at a deficit of 131.4 billion. Big number there. I mean, that's it's bigger than we've had even after, or even during the whole COVID craziness that we had a few years ago. So let's stretch this back a little bit to, yeah. So we can see even in 2020 and 2022 where the trade deficit got really terrible, it wasn't this bad. So this is kind of the worst on record so far. All right. U.S. wholesale inventories month over month grew at 0.8%. Forecast was 0.7. Previous number was a contraction of 0.4. U.S. non-farm payrolls grew at 151,000. Forecast was 159. Previous number 125. The unemployment rate is still sitting at 4.1%, or at 4.1%. Forecast was 4%, 4% even. Previous number was 4% even, so it ticked up by a tenth. And the U6 unemployment, what I really consider the real unemployment, or closer to that number, is at 8%. Previous number was 7.5%. And the labor participation rate contracted to 62.4 from 62.6. All right. That's all the data that came out this week. Pretty interesting stuff. It looks like things are kind of slowing down, but we shall see. All right. Well, let's hop into the market recap. S&P 500. Again, I'm in the habit of hitting certain buttons in a certain way. And all right. S&P 500 jumps after cutting losses despite elevated tariff uncertainty. All righty. The S&P 500 rebounded Friday after early losses as investors weighed a weaker than expected jobs report and ongoing trade policy uncertainty, particularly President Trump's reciprocal trade threats on Canada and potential easing of Russian energy sanctions. Markets remain on edge after Trump hinted at reciprocal tariffs on Canada could take effect as soon as today, significantly ahead of the previously announced April 2nd deadline. The sudden shift adds to investor unease following a week of tariff-driven volatility. Guys, I saw someone, it was on social media, they were just kind of spitballing as far as thoughts, and they're like, well, is this, Trump and Elon trying to, with this tariff, on again, off again, back and forth, are they trying to time the markets? I was like, I don't know. I mean, it just seems like they're trying to, we don't see the behind the scenes conversation, so we only see what the public statements are. All right. Just a day earlier, Trump had announced a temporary exemption for goods imported from Canada and Mexico under the United States-Mexico-Canada Agreement, the USMCA, delaying a 25% tariff implementation until April 2nd. In response, Canada postponed a planned second wave of retaliatory tariffs on $125 billion worth of U.S. goods until that date. Meanwhile, the White House is reportedly exploring easing energy sanctions on Russia in an attempt to encourage negotiations for a Ukrainian ceasefire. The potential policy shift adds another layer of uncertainty for global energy markets. Federal Reserve Chairman Jerome Powell emphasized that the central bank is in no rush to adjust interest rates given uncertainty surrounding the economy. Powell's cautious stance reassured some investors, but tariff risks and economic slowdown concerns persist. The February jobs report fell short of expectations, with 151,000 non-farm payrolls added, below the 159,000 forecast. The unemployment rate ticked up to 4.1%, slightly higher than January's 4.0%. This raises questions about labor market strength and how the Fed may respond in the coming months. Earnings in focus. Broadcom surged 7% after strong AI infrastructure demand eased investor concerns. Hewlett-Packard fell 14%, warning U.S. tariffs could hit profits. Gap jumped 14%, beating Q4 sales and profit expectations. And Costco dipped 8%, despite revenue beating estimates as consumers shift to bulk buying due to tariff-driven inflation fears. Okay. All right. So that's everything there. And I hit the wrong button again. All right. Next up, got some data here. The February employment report via First Trust and Mr. Robert Stein. All right. The February jobs report showed continued payroll growth, but underlying labor market signals raised concerns. Non-farm payrolls increased by 151,000, slightly missing the 160 forecast. The healthcare and social assistance sectors led the gains with 63,000 new jobs, while restaurant and bar employment dropped 28,000. To get a clearer picture of private and sector employment, economists often exclude government, education, health services, and leisure and hospitality from payroll data, as these sectors are heavily influenced by government policy. This core payroll measure increased by 83,000, well above the 33,000 monthly average from the past year. However, civilian employment, which includes small business startups, plummeted by 588,000. Despite a drop of 385,000 in the labor force, the unemployment rate ticked up to 4.1 from 4.0 in January. Additionally, the U6 underemployment rate, which includes part-time workers wanting full-time jobs, jumped to 8% from 7.5%, suggesting hidden weaknesses in the labor market. Let's see here. Total wage growth and Federal Reserve considerations. Total hours worked rose by 0.1 in February and are up 0.6% over the past year. Wage growth remains steady, with average hourly earnings up 0.3% for the month and 4% over the past year. The Federal Reserve likely wants to see wage growth ease closer to 3.5% before it feels comfortable cutting interest rates. Federal government payrolls declined by 7,000, the largest drop since 2022, with the Trump administration committed to reducing the federal workforce. More cuts are expected in the coming months. While this may cause short-term economic pain, proponents argue it could lead to long-term private sector job growth. Totally agree. All these federal jobs are nothing but it's just basically, you're lighting money on fire when you do that, because all the stuff they build just gets sent to the other side of the planet to get exploded. And they spend some of that money in the economy wherever they live, but they'd be more productive if they were in a private sector job, doing private sector things and providing services and goods to the private sector, because then that creates more wealth over the long term. Alrighty. Next up, or last, from Zero Hedge, Payrolls Post-Mortem, Rearview data at its worst. And this was written by Peter Cheer via academysecurities.com. All right. The February non-farm payrolls report failed to excite markets, with seasonal distortions and pending revisions casting doubt on its long-term significance. Payrolls grew by 151,000, slightly below the expected 160, but underemployment surged from 7.5 to 8, the highest since October of 21. This suggests potential labor market weakness even before tariffs and shifting trade policies take full effect. Markets remain on edge due to trade policy volatility. President Trump's tariff strategy is proving erratic, with reversals on auto tariffs and delays on USMCA compliant products. The lack of clarity is shaking investor confidence and raising doubts about the administration's trade strategy. If businesses lose faith in the art of the deal approach, it could undermine economic stability. Well, couldn't be any worse than the last couple decades we've had, as far as people running our government. So slashing and burning, I think, is going to be a positive thing. People who work for the government are going to cry and moan, but it's just the way it is. Beyond North America, global geopolitical tensions remain a market risk. The Russia-Ukraine ceasefire negotiations could shift tariff policies, and Germany's increased defense spending signals a shift in European economic priorities, potentially reducing reliance on U.S.-made military equipment. Well, if everyone quit fighting, we wouldn't need all this stuff. Despite a 7% drop in the S&P 500 and a 10% drop in the NASDAQ 100, evidence suggests dip buyers remain active rather than a full-scale capitulation. However, with the 200-day moving average under pressure, a break below could trigger technical selling. An AI market narrative is shifting from hyperscalers, big cloud AI providers, to businesses that actually benefit from AI efficiencies. If this rotation strengthens, valuations of AI infrastructure providers could come under pressure. A new executive order on a U.S. crypto reserve appears tame, allowing the government to hold seized crypto and make budget neutral purchases. However, if today's crypto summit signals an aggressive shift, it could rattle treasury markets, giving off a banana republic vibe. Credit markets also warrant attention. Widening credit spreads could escalate risk-off sentiment, further pressuring equities. Bottom line, volatility is here to stay, and tariff uncertainty, capital flows, and shifting AI sentiment will drive markets in the coming weeks. All right. Well, that's everything there. Also, some other bad news I saw. I haven't seen an article about it, but the article I was trying to read was behind a paywall, so I wasn't going to dig any further, and I didn't look anymore today. But evidently, subprime auto loans are delinquencies are spiking like crazy. Which I spent, I guess, 6 or 8 months working for a subprime auto lender when I lived in Vegas right before joining the financial advisor world in early 2006. So it's I mean, again, subprime lending in any way, whether it's credit cards are probably the worst. Did that for a stretch too, which, whoo, boy, those people are fun to talk to. But yeah, typically subprime is going to be your first delinquencies that are going to spike when the economy starts to wobble. Then it'll be your average everyday person who, they get laid off. Usually it's your people who have bad credit, usually are the kind that don't show up for work on time. They're usually the ones who get fired all the time. So it kind of goes hand in hand. It's, usually someone who's really good at their job, shows up on time, they're never late, they have perfect attendance. They're usually the kind of people who also pay all their bills on time too. I mean, they may not be super organized. I mean, I've met enough people over the years that, they're great at their job. They always show up on time. They're a perfect employee, but their finances sometimes are a little messy, but they're, they always pay their, they never miss payments, but they could be better organized long term. So anyways, all right. Well, that's everything that I had to ramble about today. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help. All right. Well, hope everyone out there has a wonderful weekend, and I'll talk to everyone again next time. Adios.